Good afternoon, and thank you for joining us for today's webinar, Liquidity, Be Prepared for What's Ahead. My name is Sean O'Brien, President of QuickRate, and I'm pleased to be joined today by Melissa Wallace. Melissa, you want to go ahead and introduce yourself?
Hello, everyone. Thank you for attending. I'm Melissa with QuickRate. Just a little background, I've worked with many banks over the years, helping educate them and implement the QuickRate marketplace. So happy to be here today.
Thank you, Melissa. Melissa's going to do the hard part of today's webinar, so I'll get us started. Just again, a couple of questions and reminders. One, we will send out a link to today's recording and a copy of the slide deck. Likely tomorrow, maybe Monday morning, but so everybody who registers will get a copy of that. And then, as always, we have a few polling questions to get us started. So I'm going to, if you'll indulge us, we got 3 here. The first one, just to why you're here today. What brought you here today? Examiner requirement, diversified funding sources, reduced cannibalization, contingency funding, looking for a non-brokered source. So we'll just give this 30 seconds or so. Okay, thank you very much. Appreciate the responses. So you can see, varied but diversified funding sources and contingency funding and a non-brokered source are the 3 most popular reasons. So thank you all very much for in answering that one. The next one is a little bit simpler. Have you joined a March Madness bracket? A simple yes or no, or what's March Madness? Right. Not the responses I would have anticipated. We're all working. We don't have time for brackets. 67% no, 27% yes, and 6% what's March Madness. Thank you. And then the final one, we may not have answers for this one since nobody's in a bracket. Who's going to win? Who do you think will win the March Madness tournament? So again, you can go ahead and submit an answer there if you'd like. Again, appreciate everybody's participation in this, but we thought it'd make it a little bit lighthearted today, and certainly the time of the year. A lot of people watching college basketball and ripping up bad brackets. Okay, perfect. Well, thank you all again for participating in those. We'll share those and keep those as part of the email that goes out in the follow-up for today's webinar. Okay. All right. So, I think, we did a liquidity webinar last fall, and, I think we felt at that time, or at least I felt at that time, right? I felt pretty good about the fact that we were probably landing somewhere in between one of these 2 scenarios where, rates had started to come down, inflation was starting to slow, albeit, slowly, but it was coming down. That we either end up in some kind of no landing or soft landing. And I think, fast forward to today, I would say more of us, and certainly I'm in the camp in between here now, right? That we still might get a soft landing, but, odds are increasing that, we might get into some type of slowdown. I don't know if it'll get to a recession, but the economy is clearly slowing for a number of reasons. One of them just being uncertainty, right? And no one likes uncertainty. We don't like it as individuals. We don't like it as running our business, and we certainly don't, enjoy it in our politics. And so, I think there's just a lot of things that are causing uncertainty. And one of the things that happens when that does occur is individuals and businesses often turn inward, right? We start saving more money. We, prepare for, a rainy day potentially. And again, I think that has implications for all of us, on the banking front. I think we're also influenced by, again, we're still kind of in the wake of Silicon Valley. And there's, the problems that we saw, a couple of years ago are still with us, on the regulatory side. I'd say at the top of that list, is concentration risk amongst our depositors, and in particular, that level of uninsured depositor in our bank. That's clearly a regulatory focus that's not going away, and it's something we should all be concerned of as we think about our liquidity policies and just our state of liquidity. Because again, it's vulnerabilities, it's potential stress events that one-offs might be okay. You get 2 or 3 things happening, now all of a sudden we may have bigger issues. I think they continue to look for just overall risk management. Again, I'm a director in a small community bank. We just, had our exit yesterday with the OCC. I think the common theme is everything they just wanted to be done better. Right? It's like there was nothing that was insufficient or anything like that, but they just want us to continually try to improve our risk management focus. And that it comes to every kind of aspect of the bank. And I think we see that on the lending side where delinquencies and past dues, excuse me, while not certainly of any cause for alarm right now, they're rising, right? So they want us to be prepared. No liquidity issues, but they want us to be prepared. And so I think that's just, again, kind of a general theme that's going to go with us going forward. Now, one area of uncertainty is, the OCC, they indicated, right, they, stopped, they rescinded all their new hire job offer letters. They, released all their probationary employees. So, maybe the next cycle of exams, take longer than 18 months, right? So again, there's just uncertainty. And then obviously the traditional external factors about sensitivity around interest rate risk, right? Still a number of banks with underwater securities, uninsured deposits, borrowers trying to potentially refinance at higher rates. All of these things, can have an impact on us. And again, on their own, uniquely in a one-off situation, probably not any cause for concern. If we're hit with 1, 2, or 3 of these at the same time, everything really changes for us. I want to just, continue to focus on these uninsured deposits. Nationally and as an industry, most banks, about 17% of our deposits are uninsured, which again, in the absolute doesn't feel like a huge number. But I think what we're seeing from a regulatory approach is the regulators would like us to make sure we have secured borrowing capacity to cover those uninsured deposits. Now, that's a perfect world, right? That's what they would like to see. They recognize that all of us aren't going to be able to do it, but that's clearly what they are, like their best practice is for us to have that type of borrowing capacity. So again, just as we think about our liquidity this year and those uninsured deposits, just something to continue to keep in mind. Our day-to-day realities, these probably really never change. The priorities of these or the prominence of them, on a daily basis, may fluctuate. But I think we're all, going to continue to deal with deposit pressures, right? Whether it's just trying to keep what we have, or if that's going to be an impediment to growth, right? We have the lending conundrum of, do you want to lend into weakness? But on the other hand, for most of us, that's what we do. We want to continue to lend. That's how we're going to drive our earnings. We need to be able to lend, and deposits can be a limiting factor in that growth plan. Credit quality, again, while nothing terribly alarming yet, clearly over the last 12 months, past dues and delinquencies have gotten worse. So it's something to continue to monitor. Again, we've touched on the liquidity uncertainties and again, just the regulatory focus that's going to be with us here throughout 2025. More of our reality, right? The interest rate rise over the past couple of years have certainly, impacted our balance sheets. They've impacted customer expectations around, rates that they're looking for their deposit accounts, and they've obviously impacted our margins. As we've talked before on these, coffee talks, webinars, et cetera, depositor behavior is probably likely impacted forever, right? There's going to be continual and increased competition for every deposit. We've probably all experienced some decline in our non-interest bearing deposits. And I think the inertia that again, was almost a bedrock of our industry, can no longer be taken for granted, particularly given the technological ease by which our depositors can move money. It raises an old, a kind of an old ongoing question, about stability of deposits versus pricing deposits, right? And I think for a lot of us, you might be in a window where, the scale may tip a little bit towards stability over even cheaper deposits, right? Because again, in order for most institutions to continue to grow, we have to have confidence that our funding sources and our deposit base is there and it's growing with us, to achieve our growth goals. So, I think for us internally, then we need to continue to review our funding and risk management practices around liquidity to make sure they're in sync with what we want to do in our business plans over the next 12 to 24 months. I think we have to potentially start looking at, we certainly should be looking at our contingency funding plans on an ongoing basis. I don't want to introduce stress testing in here just yet, but we need to be, thoughtful about it. But contingency funding plans, I would make sure I am revisiting and refreshing, on a regular basis, right? Just to make sure our sources are there and we're clear on where our capacity is, and our expectations that, examiner expectations are going to remain elevated. So certainly no easy decisions. Again, I think, balancing the cost of, trying to retain deposits and reward our best customers is ongoing, and then just continuing to track liquidity as we can, but at a price, hopefully, that, is meaningful for us, right? I mean, I had a conversation the other day with a fire district, for our community bank, and they said, you can have all the money you want, but you got to pay X for it. And, and we're like, well, we just can't, like, for our bank, we couldn't afford to do that, right? And so I think we're just mindful of, not only do we need deposits, but making sure that they're at a price where we can still effectively make margin on that money is important too. So where are we with our deposits? For most of us, I would say the pressures we felt maybe a year and a half ago, 2 years ago around, erosion and, deposits fleeing, I think for most of us has subsided. And I think, for most of us, growth has returned, albeit anemic, but it's at least positive. And, I think we recognize since, COVID, deposit growth has been difficult, right? We had that immediate influx of deposits into the system, but since then it's a little bit been harder going. They remain expensive. There's no question about that. And for us, as most community banks, we continue to rely on CDs, for our funding growth. And as we touched on, deposits are expensive, and they're competitive, and kind of equal with a lot of different market rates. Unfortunately, for a lot of us, we have not seen our interest expense dropping. Most of our deposits are already low cost, right? Many under 25 bips. But we do see kind of a changing deposit mix. Certainly low rate savings and checking accounts are, again, some of the primary targets of campaigns to transfer them to a money market or a CD account elsewhere, or maybe even internally within the bank. So in some respects, a lot of the quote unquote, easy down pricing has already occurred. And so we have to really be thoughtful about trying to make sure we're pricing, our best customers who are those continual targets, maybe proactively. So we don't necessarily have to meet a market rate, but we still probably need to accept some cannibalization of our own to reprice those a sec. And then we need to continue our lowest rate customers. Again, we need to be mindful of them, that they are the ones that are probably, again, going to be the primary targets of digital campaigns and just other marketing campaigns. So we need to make sure we're monitoring where those customers and where those rates are. So remain vigilant, I guess, we always know that, but we need to continue to do that. Again, I think proactive communication with our largest customers, our deposit customers, is critical. Again, maybe make the first step in meeting them somewhere. Again, it doesn't likely, with our best customers, probably doesn't have to be the highest rate, but some acknowledgement of how good a customer they are and the value you place in their relationship probably warrants some type of conversation to make sure we're staying ahead of the curve and don't find ourselves in a defensive or reactionary pricing conversation with them. We have to recognize, single relationships are the ones that are most likely to leave, and that might be okay. We don't want to see anybody go, but those are probably the most likely to leave. And again, we should be focusing on trying to get more accounts and more relationships into our customers, because then it does reduce the likelihood that they're going to leave or move any of their deposit accounts. As we touched on, establishing monitors for attrition, I think something we want to be mindful of. And then again, a couple of other things, just account size, matters, but when pricing, but we obviously have to have some discretion on how we're going to price, our various customer accounts. So, how's that all translate into liquidity management, right? Again, I think it's, revisiting our policies and procedures to make sure they are up to date and in sync with our business plan and strategic plans. We say it every time, but funding diversification to me has never been more important, right? You have to be able to tap into all of your resources and all of your available sources of funding. Focusing on those concentration and policy limits, and again, make contingency funding, part of your ongoing liquidity discussions. Again, continuing to focus on uninsured deposits, I think is going to be here. And I think the other thing that, I think we've mentioned this before, but if you're not signed up with the Fed discount window, I would strongly encourage you to do so. They accept more types of collateral than, say, the FHLB. Much of the stigma that's used to be associated with having an account at the discount window, I think has gone away. The Fed has certainly worked to try to market and remarket themselves to that effect. But again, making sure you have as much available collateral available to you is important, right? In talking to our OCC examiner yesterday, he made the comment about the FHLB, where in the past they've always just been kind of traditionally collateral lenders. Their discussions with them that if they're stressed, they're going to look at the overall kind of makeup of the bank and not necessarily just lend on the collateral that they already have. And so to that point, making sure you have other sources in place, to make sure you have that capacity at the FHLB that you think you do, I think is important. So again, the Fed, it's not something you can do overnight. So make sure if you don't have that relationship, I'd strongly encourage you to make sure that is in place. Again, cost of liquidity we've talked about. It's expensive, but making sure we're taking advantage of all of our sources. There's in the chat that thank you for submitting that. The OCC has mentioned to us a few times on the Fed discount window too, and that potentially may almost become a requirement for them to have it. I really think that's where we're going. And again, the fact that they accept more collateral, it's just good practice, right? It's good practice for all of us to have multiple borrowing relationships. It gives us more flexibility, and I think even within your own policies, make sure your policies are flexible enough that you don't essentially hang yourself, right? That you don't kind of set yourself up to fail, and that's why a good refresh on those is important. Particularly when there's no stress, right? I think one of the most common things we always see with liquidity policies and plans is limiting ourselves, to how much wholesale funding we can actually accept at the bank. And again, we often make it when there's no stress. We make that number very low, and then times get stressful, and we want to go higher. And then they're at the likelihood that's going to be accepted or seen positively goes way down. So now when you're not in stress, make sure you give yourself ample room to include as much wholesale funding, as you can, and then obviously establish good measuring and monitoring practices to both monitor your funding sources and then availability and capacity as well. I like to always just put the definition of liquidity, as the ability to raise money quickly at a reasonable cost without principal loss, because again, I think a lot of us feel like we have good liquidity, but it's often you have liquidity until you don't. And then, as I mentioned, one problem, your liquidity may be able to handle it, but your liquidity, if you start to have credit issues or, a couple of issues, they just can start to snowball. So we want to make sure we stay ahead of it. Again, our funding framework needs to be flexible and inclusive. Obviously, we're all trying to, work in our local markets. Tomorrow, we have a webinar with Infusion, our parent company, to talk about, digital marketing efforts and campaigns that they do to help with our local deposit gathering. Obviously, here at Quick Rate, we think we are as good, if not the best, source of wholesale funding, particularly non-brokered. We are the best in non-brokered funding, and I just think it should be part of everybody's, toolkit. Again, as we move forward, we want to continue to make sure we're optimizing that wholesale funding, pricing our deposits effectively as we possibly can, monitor our competitors and our deposit attrition, and then, locally or in our retail markets, make sure we're getting a good blend of active and passive pricing with our customer base. With wholesale funding sources, right, again, you want to just, employ a diverse mix of them. You want to regularly confirm and contest or test their capacity. And again, just monitor them and work with us, and we'll help you do that, right? Whether it's, working with your policies, testing for capacity, making sure you're ready to issue whenever you want. Melissa and our customer service team as well can always be a resource to you. And Melissa's going to talk about that here in a little bit shortly after I finish. And then again, I think we just have to be aware if we get into some trouble that the expectations around active management of liquidity increase. Again, I don't think anyone's near that right now, but I think, again, if things, do slow down, we see a rise in some credit issues, it might become more of an issue. And so I think you have to ask yourself, right, are we able to monitor it monthly? Are we using tools such as quick analytics to report to our management teams or boards? A lot of different ways to, again, just put a fresh set of eyes on how you're thinking about and monitoring and managing your liquidity. As I mentioned, I don't want to spend a whole lot of time on stress testing. Just know that, again, we're probably moving closer to, when this might be necessary. I don't think we're there yet, but contingency funding plans, we definitely are. So again, revisit your policies, revisit your contingency funding plan, get that discount window account in there, and make sure you are ready to go. Just some possible contingency events. I really put this in here more just as a thought idea. I don't want to spend a whole lot of time on it today. And then my final, thoughts and takeaways. Obviously there's a lot of here. I think the ones I really have focused on today, is maintaining, loan and deposit pricing discipline in our local markets. Reviewing our policies and procedures, monitoring those uninsured deposits, and again, incorporate wholesale funding sources like Quick Rate into your contingency funding and ongoing liquidity plans. And, again, I think, as we all know, deposits in our local markets are tough to get, and that's why there's Quick Rate to help. So at this point, I'm going to turn it over to Melissa, and she is going to take the second half of the presentation.
All righty, I'm gonna requested
Yep.
to share. Perfect. And can you see my screen now?
Not yet.
Okay. Okay.
There we go.
Perfect. Thank you. Thank you, Sean.
You're welcome.
So what we'll do is take a look at the Quick Rate Marketplace and talk to you about how you can use it in conjunction with other sources that you have in place, as Sean talked about, diversification, staying within your policy limitations, not over concentrating in any one sole source of funding. So the Quick Rate Marketplace is designed just to be one of those tools, as Sean mentioned, in your toolbox to have available to you as an alternative part of your funding plan. With the Quick Rate Marketplace, what's nice is that we can help you on either side of your balance sheet. So banks use our market as a way to work direct with other institutional investors, banks and credit unions, to bring in non-brokered funding, again, as a way to diversify. But on the flip side, if you have excess liquidity, you can always use it to invest with the banks that are offering rates on Quick Rate. So it is nice in the way that it is available to you on either side of your balance sheet. We do work with over 2,800 institutions all across the country. And again, we've been around since 1986. So we're here to help banks. We also, as Sean mentioned, customer service. Part of utilizing the Quick Rate Marketplace is having unlimited access to service and training throughout the entirety of you utilizing the marketplace. We are an industry leader and we are recognized by the ICBA as a preferred service provider, and we have been now since 2002. And what I'm going to do is go ahead and flip over to the live screen here. Let's see. And take you through just a brief overview of the marketplace. So I am logged in live. So these are rates and banks that are out in the marketplace. I will focus on the funding side, the issuer side of utilizing Quick Rate, but I'll also touch on the investment side as we go through, because I think it's important for you to know the characteristics of our investors and how they use the market and how they work directly with you and why they work with you. You can have as many banks or as many users at your bank access the marketplace. When each user logs in, you'll just have a brief snapshot of your dashboard here to see what, if any, investments you have or deposits you have are maturing that day, any rates that you may have posted in the market for new deposits you're looking to bring in, or any rollover rates you may have posted. I won't focus here, but I will let you know that our banks find this to be a very stable funding source for them, and I'll touch on that as well. And then inquiries are just electronic communication, because what we do very simply is bring the buyer and seller together directly through the marketplace. We are not a deposit broker. We don't get involved in the transaction. So it is a way for your bank to work with other institutions to bring in non-brokered funding. It's institutional only. We do not have any consumers or individuals that use Quick Rate. So our banks also like it because, in conjunction with other sources that you have in place, there may be times when you may be at risk to cannibalize or reprice an existing percentage of your deposit base. So our banks like it because it is a closed market. It gives you the ability to bring quiet money in without running the risk of cannibalizing or repricing, keeping your marginal cost of funds down. So that's another way that our banks will look to utilize Quick Rate. The first area that I'm going to peek through here with you is view rates. Now, this is where the investors focus, and this is where your rate or rates would appear when you offer them in our marketplace. But I do like to show you the market. I have it expanded to show you all of the rate terms that you can offer rates in. Outside of that, I will mention, if I scroll down here, you can see that Central Bank is offering some maturities outside of the standard. So you have that capability. It will let the investor know that you're offering a special rate term, because in our marketplace, our investors are generally just securing deposit insurance with each bank. So they're taking that portfolio, they're breaking it up into pieces just below the insured limit, and they're just moving down the list to the next available bank that they haven't already invested with. We do have tracking built into Quick Rate. So no matter what term, when an investor comes into the market and selects a term of choice, they'll sort from high to low. And as they're using Quick Rate, their investments will be tracked. So they'll know by way of a check mark to the left of the bank name, a bank that they've already invested with, to keep them, again, from going over that insured limit. So they're just going to move down the list to the next available bank, which for you means that you don't have to be the highest rate or rates in the market to attract deposits. So they'll select your bank name, and this is the information that will appear on your bank to the investor in the market. Your general location information, everything will be tracked by way of your FDIC insurance number. And then you're just going to provide your basics, your min and max, how you pay your interest, frequency and compound type. Your wire instructions are also going to be available for the investors, and included within that will be your wire in and out cutoff time in Eastern time provided to them. Generally, the investors are going to communicate with you over the course of the morning, their time zone. So they'll look for a quick response back from you, and we'll step through this process briefly so that they can meet your wire cutoff time and have all of these settle same day. So same day settlement is the goal within Quick Rate. Below that will be financials that we obtain from the call quarterly. So we will provide financial information on your institution to the investors. Our only criteria for a bank to utilize Quick Rate is that you're FDIC insured. At the very bottom, we do track history. We'll have you activate a history alert, which will notify you in the event that a change occurs in status to any institution that you're working with. So we'll keep you up to date on that. Here we have a name change. We see a lot of M&A activity, insurance number changes, but those are the typical types of changes that we see. So we will keep you notified when that does occur. So what an investor will do is they're going to go ahead and click on the rates of banks. Let's say this investor is going to place $1 million. So they're going to start with 235. They're going to pop down here to 7. They can go to different terms and build what we call their rate cart. They're just going to go up and access their cart. They're going to tell the system how much they want to place per institution and go ahead and set that amount. And then they can go ahead, it'll summarize their information, but they can go ahead and communicate with multiple banks at once. So this is a nice feature if you are looking to invest, because you can communicate with more than one institution at a time. When you're submitting an inquiry to that specific bank, they only see that it's coming to them. And so they'll go ahead and send the inquiry. You will, at the bank, have predetermined, we identify them as CD investment contacts. These are the individuals at your bank that will receive the automated notification once an inquiry is submitted to you. So they will get the notification. They don't have to keep QuickRate open or remember to log in to see if anything's happening. As they go about their day and get a notification, they'll log in and it will take them to the appropriate inquiries area within QuickRate. And I'm going to show you a screenshot here as to what it would look like. In this example would have been your bank receiving 4 inquiries. So you'll select an inquiry or a specific investing institution, and this is the information that you'll see on that investor. So you'll always see the amount they want to place with you, the rate. The rate is the rate you've posted on QuickRate. That is what they receive. And then their general information along with their payment, tax ID information. But most importantly here is their documentation and satisfying CIP. So again, we don't have consumers, so you're not dealing with BSA and the consumer regulations within QuickRate. Our banks like it because CIP is minimized when they're working with other financial institutions, being that you're federal and state regulated, which exempts you from the regulations definition of customer. So from our investors, we ask that they provide you not only with a W-9, but also a resolution, which includes not only a listing of signers, but sample signatures that also keeps you from having to require a separate signature card. So just keeping the process, the goal here is just very simplistic and paperless. So providing you what you need. These are PDF documents that live electronically, but you can forward these on to whomever will be setting this up within your core once you receive the wire from the investing institution. So you always will reply back to the investor, accepting or declining. You're never obligated to take it any more than you want or need through QuickRate. So upon a designation or an acceptance, they'll be notified. They'll go ahead and log in and access your wire instructions and wire the funds over to the bank. Once you've received the wire, you've booked it into your core, you've assigned it internally a certificate or an account number. That is keyed in, tied specifically to that investing institution. And the last function here to close the loop on the transaction is just simply posting it to the portfolios, both your deposit and the investment portfolio, and then automatically creating and importing the safekeeping receipt as a PDF link into the portfolios as well. So we'll have you set up a deposit receipt with customer service upon training. They'll incorporate your logo, and then the system just merges in all of your information with the investor. And of course, just the basics here, your term, your rate, your paid and compound type, your withdrawal penalties covering all terms, and then stating upon maturity whether the account auto renews or not. So this is the basic information here, and I'll show you how that views in the portfolio. So this is an investment portfolio. So if you posted, if you're Altera Bank and you've posted this to the portfolio and created the receipt, this is how you would appear in their investment portfolio with a link to the safekeeping receipt. This would automatically appear in your portfolio type deposit with their information. So you don't have to key in anything manually, it loads automatically. And that closes the loop on the transaction. So when you look at QuickRate, a lot of banks will look at it as a virtual branch. So they're submitting electronically, you're reviewing their information, you're replying back to them, upon acceptance, they're wiring the funds, you're booking it into your core, they are your customer, and then you're making available the deposit receipt. So again, that closes the loop on the transaction. The next area that we'll peek through here is the publish rates area. So this is where you go when you post a rate or rates in the marketplace, and we give you a couple of different ways to do that. Before we go there, though, we're going to take a look at marketplace activity. because we're not a broker, we don't get involved in the transaction. We don't track it bank by bank, but we do give you activity as a whole. We do this the first of every month for the previous month's activity, and we also track it on a weekly basis as well. So if we take a look, in this example, we'll peek at 1 year. It's the most popular maturity with the investors. First, we'll just take a peek here at new inquiries. And what this is going to show you is where banks obtain deposits posting their rate within a certain position. So positions 1 through 10 indicates any bank that posted a rate within the top 10 rate positions the month of February. These banks took in just over 152 million, and they paid an average rate of a 4.45 for the deposit, and then on down the list. So if you posted between 11 through 25 here, 26 through 50, and then again on down the list. So you don't have to be the highest rate of rates in the market. And because of that, a lot of our banks look at their situation when they go to offer rates in the market. You know, how quickly do they need, what are they looking for, and how quickly are they needing to bring in that money to help them determine where do they want to position themselves in the market? Do they need it quickly, or do they have time to bring them in slower, pay less for them so they can start a little lower in the market? So this just gives you an idea for where activity is transacting. Again, this is new money. I will just touch briefly, as I mentioned earlier, with the rollover rates that you can offer and the stability of the deposits through Quick Rate. I will show you that rollover rates are posted independent from any rates that you post in the market for new deposits, and they're only viewed by your investor within a maturity period of time. So our banks like it because they can, as you can see here, they can post a rate at a position way below the top rates in the market. As you can see, more rolled over below the 51st rate position the month of February than in the top 10. So not only are our banks able to retain deposits, but they're able to do it at a rate much lower than the top rates in the market, because the investors would rather stay with you. It's easier for them than start all over with another institution. So I think this is important to note, because if you're looking to retain deposits, you have, you know, the ability to do so, and to do so at a rate below the highest rates in the marketplace. So I'm going to go back here to publish rates, and we give you the ability, if you want to offer a rate at one or multiple terms, you can do that, or you can use positioning. Our banks like positioning because they do want to benchmark amongst the other rates that are being offered, so they aren't paying any more than they need to for the deposit or deposits at that time. So what we do when you go into this area, by term, we give you the ability to plug in a rank or position at any term, one or multiple terms, and then we give you, as of the time you select this feature, what the market looks like right now. So it'll show you the top rate at each specific term, the 10th rate position as it falls, the average of those top 10 positions, and on down the list. And then the postings column on the far right will let you know how many banks are currently offering rates at each of those specific terms. So you could come in, most banks get a feel for where they're comfortable position-wise. You know, a lot of them want to start out again a little lower, see what type of activity they get, and then you've got the flexibility to adjust your rate up or down at any time. So it is nice and that you have the ability to do that. So let's say you want to come in, and I'm just going to plug in a few here, maybe 25 here, maybe 15 here. So again, just plugging in a position. And again, a lot of banks get very comfortable for where they like to start position-wise pretty quickly. And then you're going to set the position in the market. And what Quick Rate will do is come back and identify the rate you would want to post, placing you at or as close to that rank or position. The goal is to keep you from being tied with a large number of other banks, just being very strategic in the rate positions, because what you'll find, if we take this off, you don't have to use it. You can always change it and then reanalyze. So you're at 21. So in this example, it shows you there are 8 banks right now posting a 435. So by paying very little more for that deposit, it has moved you above that pack of tied banks and moved you up to the 21st position, which moves you that, you know, much further up, because it doesn't matter how many banks are below you. All that matters is how many banks are above you in bringing in inquiries and deposits and the speed at which you need them. So again, just being strategic. So it takes the guesswork out of positioning for you. So that's why a lot of our banks will like to use that feature. Now, you can set rates a couple different ways. You can set it by a start and end date, and just when you've reached your limit, you can come in and remove or lower your rates in the market if you do want to do some bottom fishing, or you can set term limitations, either per rate or total limitations if you're looking for a specific amount of money, and then select your action. How do you want to be notified? Emailed, remove rates, lower rates in the market. So we give you some different parameters when offering rates as to how how you prefer to do that internally. And then when you're ready, you just hit post and they go immediately out into the market. Again, you can come in and make changes at any time, remove your rate at any time. If you receive an inquiry, anytime you're going to remove rates, you just decline it and let them know you've gone out of market. So again, never obligated to take in any more than you want or need through the quick rate marketplace. So you control what you're bringing in and how quickly you're generating those funds. Just a few more areas here briefly. The rate survey is a snapshot of the entire market. It is a printable version of the entirety of the market. So a lot of banks like to use this when they are looking at other sources to compare information. We do have different tools and different reports that you can use to cross-reference your core. So we've got a bunch of information built into here. And of course, we're always happy to talk you through that in more detail. Under resources here is our regulatory information. Debbie's our Director of Regulatory and Compliance. She's been at Quick Rate over 35 years. So she is here to help and provide assistance to you at any time as a subscriber to Quick Rate. What we've done here is she's just incorporated a lot of information. If anything is happening in the marketplace, she puts together a document for you that explains it. What does it mean to you as a subscriber? Kind of what the bottom line is. So we like to make sure that we're providing you with any and all information that we're asked for, and it's here for you in the resources area. Another thing we will provide to you when you subscribe to Quick Rate is a risk management workbook and sample liquidity policy templates. As Sean mentioned, making sure you're staying within your policy limitations. So in providing you with the templates, we give you a very simple way for you to get those policies in place without having to write policy. So our banks really like that feature. So we try to do anything we can here to make the usage of this market as easy as possible. We do give you the ability to manage all of your information internally there. You can have as many users set up on Quick Rate. You can set different authorization levels, email roles for your users. And then the information that we gather from you to be able to utilize Quick Rate are just your rate and wire details. So we have you complete this and provide this back to us. We get this input into Quick Rate, and then we set up training with you. So just so you know, the process of implementation to Quick Rate, we can generally have you out in the market within 1 or 2 days. So training's done over the phone, and it generally takes about an hour. So we try to do everything we can to keep this process extremely simple for you. And now I'm going to go ahead and switch back over to, can you see that, Sean?
No, I still have the live screen.
Oh, okay. Let me go back here.
And Melissa, just maybe as you can as well.
Oh, I'm going to let you share back.
Yeah,
Sean.
I'll go ahead and share. But we had a question come in just about
sure.
customers issuing at 249,000. Can you just speak to why most of our investors want to stay under the 250?
Right. So they like to stay. It's a direct insured investment with an FDIC insured institution, not facilitated through a third party. So they like to come in just below that insured limit, so they're staying under 250. So that's the goal for the investors, is staying right under that insured limit. So they'll usually come in anywhere between 245 and 249,000.
Perfect.
You can set your min and max to what you would like it to be.
All right, thank you. Again, if you have any questions, go ahead and submit those in the Q&A or the chat feature. We'll certainly take those. Just as a reminder, beyond Quick Rate, we do a number of different things, including quick analytics. Many of you are familiar with our CECL Solver product.
Oh, Sean, I don't see your screen, I don't think here.
Did it come up yet?
Oh. Okay, I do. I'm sorry.
Okay.
It is. Yes.
Sorry. Yeah. Many of you are familiar with our CECL product, but there's also great bank and peer performance and information by your page. There's a good liquidity report and liquidity tab that you can use internally as well. For those of you who aren't familiar with our IntelliCredit application, again, we provide third-party loan reviews, but equally important, we provide a portfolio analytical tool that can be instrumental in aggregating and disaggregating your loan portfolio. Again, if you have any questions, go ahead and submit those now. Again, next steps with us, we certainly would encourage you to review pricing, your bank situation, talk to Melissa about any of this. Melissa, anything you wanna add?
No, just if you're interested, like I mentioned, in taking a look, in more detail, talking more specifically about your bank situation and how we may be able to benefit or help your institution, we're happy to do that and take you back through or show anybody else there at the bank that you'd like the Quick Rate Marketplace. We also have the ability to give you a username and password, which is the one I used today to log you in, so that you're able to get back out and look around on your own. So we like you to be able to do that as well. And then if you're interested in pricing information for your institution, or if there's anything else we can provide, just, please reach out and let us know. We're happy to talk with you.
Yes, and so I put up essentially it's just if you'd like to schedule a tour pricing, you can go ahead and click on either one of those, and Melissa and the sales team will follow up with you. So again, thank you all very much for joining us. We do have some additional webinars coming up tomorrow. You can join us for proven lead generation that attracts new relationships. Dan Marks from Infusion. Our parent company will be hosting that. I'll be on there as well. And then April 4th, our dear friend Paul Allen from Saltmarsh will join Steve and I for our coffee talks. So again, certainly register. Just like today, if you register, you will receive a copy of the slides and a link to the recording in a follow-up email after, in this case, for today's webinar, most likely tomorrow, possibly Monday morning. I don't see any final questions. So again, thank you all very much for joining today. We appreciate you participating. Look for our upcoming webinars. Again, if you have any questions, call us or email us at info@quickrate.com. Melissa, any final words before we let everyone go?
No, just we really appreciate you taking the time today to take a look at Quick Rate, and we hope to get the opportunity to speak with you.
Agreed. Thank you, Melissa. Thanks all of you for joining. Let us know how we can help, and we'll look forward to seeing you soon. Thanks so much.
Thank
Bye
you.
now.
Bye-bye.